and we're gonna start momentarily. Assuming everybody's on mute. So go ahead and go to the graphic. So to start with, we want to kind of give you an update on the Houston overall market. The reason we're attracted to Houston is because it got a devastating blow in 2014, September, as oil crossed the $100 barrel mark and headed all the way to $26 by the April or May of 15. That caused the oil industry to lose a ton of jobs, and that caused a lot of other people to lose their jobs. And the oil industry had, the office market had expanded by about 30 million square feet of brand new space, including campuses for a lot of the big oil companies. What happened is we wrote a white paper in the summer of 14 saying that oil was going to go down by $50 a barrel, that jobs were going to be lost, office buildings would empty out, and prices would go down, and would create a great opportunity for us to buy buildings about 4 to 5 years out. We thought 19 or 20 would be the best time, but because of COVID, it's turned out that right now is about the best time. So in looking at the Texas markets, we're excited to tell you that California, Chicago, and New York are contributing greatly to our well-being. Dallas had 175,000 new people last year. Houston picked up 134,000 people. There are 44 square feet of office space for every man, woman, and child in the Houston market, and 134,000 in-migration absorbs 5.8 million square feet of space. And these are for accountants and office workers and, county and community college and all the different jobs that support a community get increased as the population increases. So it really only takes about 4 years for 20 some odd million square feet of space to get absorbed with that kind of in-migration. So I think we should all thank California for their participation in this project. We also want you to know that the work from home thing is going to take a couple more years to work itself out, but we feel like participation in the workforce at the office in Houston is one of the highest in the country. I think it's what, 62 or 63%, and that's rising. The laggards are in the public employees for federal, state, and county school districts and whatnot. So those are the areas that are having the most trouble getting rejuvenated. Obviously, everybody knows that oil is probably back to $82 a barrel. They feel it at the pump. I think gasoline is $3 a gallon again, or $3.20. So Houston is on the rise as the in-migration and oil is recovering, and it's starting to absorb space. Rents are still very low, and there's a lot of competition, but there seems to be a flight to quality. We're seeing companies move from Sugar Land to the Energy Corridor, from the Galleria to the Energy Corridor. And the building we're going to talk about is in the Katy Freeway area, which is the part of the Energy Corridor. There have been probably, Roger, eight leases done in the last 90 days?
I think so, 8 leases done since March of 22, and now there are 11 large block tenants leases out looking right now.
There's 11 looking right now.
Yeah, 8 already completed, 11 after station right now. We know that 2 of them had confidentially walked through the buildings to speak of.
Right. So let's talk about the Energy Corridor. It's 24 million square feet of office space. What you'll find out here is that all the newer buildings are 93% occupied. Every building that has been built since 2012 is economically full. All the buildings that are built since 2000 are about 85% occupied. And the building that we're looking at over here is built in 2006. So it is 16, 17 years old. The building right to the north of it is 100% leased to Wood Engineering at 2350 triple net. And it sold 18 months ago for $337 a square foot to a Qatar investment bank named Leisha. The building next to it sold for $340 a foot in August of 15. At the same time, the same buyer bought this building, leased to Wood Engineering, for $305. So the building in between all three of these is now empty, and we are buying it for $54 a foot, or 17% of what these people paid just to the north of us. The reason is because the building's empty. Now, the reason the building's empty is because the current landlord was unable to attract a tenant before the existing tenant left in October of last year. And the building needs to be reconditioned to have more modern finishes with more light and less sheetrock, more glass and less sheetrock. So we're going to show you what we do to a building in a few seconds that would make it more attractive to tenants. This is a building that's about, what, 4 miles away, 5 miles away, that we bought for $39 a foot in a less attractive neighborhood and a less attractive building. So this was a purchase from 2 years ago. This is what the lobby looked like when we bought it. That's the same lobby. And again, this is the same shot from a different angle. So this one's looking at to the west and looking into the bay that now has glass all across the front of it. This was a break room down the core. And this is what the core looks like now. As you can see, we put high top tables, games, breakout areas, little rooms for people to use a phone or to have small meetings. So next, this is what the average 22-year-old engineering office space looks like. This is what today's office space should look like. This is what one person used to sit in this box. And with a glass across the front, it's completely different. An old kitchen, a new kitchen, an old bathroom, a new bathroom. And this is where lipstick comes in. That's lipstick. It's just paint. So when we refresh these buildings, we have a much higher probability of landing a tenant. When we buy these buildings for unbelievably low basis, we have a much higher chance of attracting a tenant because we can afford to advertise a much lower rental rate. Just for your information, this lot that the building sits on is appraised at $6.7 million. The last buyer paid $45 million for it. Translates to $60 million with inflation today. We're paying $13.7 million, which is 2 times the value of the land. The garage, which is 1,070 cars, would cost about $24.6 million to rebuild today. The building itself would probably cost about $40, well, fully leased with tenant improvements and commissions paid. Our all-in basis for this asset, when we're full, 2 to 3 years from now, will be around $28 million. And we don't know what the building will sell for, but our low-end guess is 45, and our high-end guess is 60. To replace this building today with tenants included would cost about, brand new, would cost about $80 million. So we intend to beat the neighborhood on rental rates. The current asking rate of all these buildings around us is about between $18 and $21. And our first year rental rate offer for ground floor only will be $13.75. If somebody wants to rent the 5th floor, the ask will probably be $15.75, still $5 below the neighborhood, with brand new finishes already in place. So, you know, the neat thing also about this building is it divides up into 10 different bays. There are 25,000 foot bays facing east and facing south, or facing west. So if we don't really expect to lease the first tenant 25,000 feet, our first tenant will probably be between 100 and 150. There are only 5 blocks of space in the energy corridor remaining that are 150,000 feet or greater. And ours is one of the 2 nicer blocks of space. Adjacent to this building and further out west are 2 hospitals. That's Texas Children's Hospital and Methodist West. And if you back out even further, the reason this area is garnering a lot of attraction is because this whole area is called the Katy Independent School District. And it's one of the largest and better school districts in the state, or in the Houston area. You can back out a lot further. So there's a Katy Mills Mall, and then there's now a tremendous amount of industrial product out here. Some of you might have driven by Rooms to Go, Igloo. You know, they're all building all these great big industrial complexes out here. So it seems to be a trend of moving closer to where your employees are based. We are getting Floor Daniels coming from Sugar Land into the energy corridor. Bechtel, Brown, and Root is moving from the Galleria into the energy corridor. Schlumberger, Baker Hughes, Technip, Apache. I mean, there's like 20 people, big names, moving into the energy corridor. As the bigger buildings are filling up, then the next ones to go will be the ones that are a little bit older, and that's this building at 2006 is just right for engineering firms. There's also $3 trillion worth of engineering projects that'll be let for infrastructure across the U.S. and Houston seems to be the engineering capital of the country with the most engineers per capita, I would suspect. So with that, what else do you think we should talk about, guys?
The flight to quality.
Flight to quality.
As part of the return from or to the office from the building.
Yeah, so in the energy corridor, every building that's 2012 or newer is 93% occupied, which shows us a flight to quality. By the end of this calendar year, I wouldn't be surprised if those buildings are 97% occupied and starting to raise their rents.
And one of the adders to that is our repositioning efforts with the natural lighting class. It creates the environment that the employees want to go back to the office for. And that's a big part of the community work, is they want to have the
yeah. So what we do in a lot of our buildings is we add amenities. The amenities for this building will be a little play area on the left side of the front door. It'll have high top tables, pinball machines, foosball. There'll be soft drink service, food service, grab and go market, and it'll be like little enclaves of seating areas where people can come out of the 5th floor, bring their computer, tie into the Wi-Fi and get work done and still visit with a few people. On the other side of the hallway, on the right side as you walk in, we'll probably have a training room and then 3 conference rooms with a food service set up in the middle so people can have meetings there instead of having to go all the way to the 5th floor. That way each of the tenants don't have to have as many conference rooms inside their space if they have the community conference rooms they're allowed to use.
How long does that process take before you get to the lease phase? You got a conversation.
Because Andrew is so slow, I would say 4 to 5 months after closing, we'll be show ready. But we'll be showing the property during the entire construction phase. We won't be missing any tenants. And we can always take them to other buildings to have them show them exactly what our stuff looks like. We have 4 million square feet of product in Houston that we're currently leasing up that we bought at substantial discounts. So this is happening all across the city.
Here's a question from Steve asking about the age of the buildings to the north of us.
Yeah, so go back to the aerial photograph. So Steve, the building directly north of us was built in 1999. Our building was built in 2006. We're 7 years newer than that building. Same builder built both of them. We have a much nicer lobby, entry floor, but it's the same construction. These two buildings were completed in 14 by Transwestern and leased up and then sold in 15. So they're the newest. And I don't know, I'm trying to find out what they paid to build them. They do look a little nicer, and they have a shared garage structure in the middle. So the same owner, Griffin, bought both of those, and we recently bought a building from Griffin down the street. You want to go see if we answered this question? Does that answer your question, Steve?
And please feel free to unmute yourself to ask any questions, or
yes, that's helpful.
Okay, yeah, no, Steve, we love the age of the product. This is a 17-year-old building that we're paying 16% of replacement costs. That's probably a 310 to 320 replacement cost on that asset.
Do you anticipate using any debt on this project?
We have a $10 million loan arranged. Is it 10 total?
$15 million.
It's 15. We really want to pay cash for the building, so we're trying to raise 17 million, which is 1.6 million for improvements, 13.7 to buy it, closing costs of 300 or 400, and then have $1.5 million sitting in the bank account, which is a whole year's worth of holding costs. We can take up to $7 million of debt at closing, and it's at about 8%. And it'll be interest only for the first 2 or 3 years. We would prefer to pay cash. We're trying to raise 17 million total. In order to raise 17 million, we gave a much more attractive split to our investors. This investment vehicle has a 10 pref, 50-50 split to a 15 IRR, and then 50-50 thereafter. So this is much more attractive than the formula we've used for the last 20 years, which is an 8 pref and a 50-50 split. Anybody want to type another question or unmute and ask?
One thing that ask you about manufacturing. We talked at some time about the Ukraine conflict and Germany's being one of the manufacturing powerhouses, and a lot of those contracts are coming to the Houston area because Houston is kind of a sister manufacturing juggernaut like Germany.
Right. So the Houston market back in 1996, when we started building industrial buildings, we built 51 buildings between 96 and 14. And these were all manufacturing facilities. At the time, there was 450 million square feet in 96. 50 million square feet of it was manufacturing. I don't know the numbers today, but Houston is one of the largest manufacturing centers in the United States.
They're a net positive exporter too. Okay.
What year was the building purchased? Prior owner of 1970, 178 foot. It was bought in 2011 by a $70 billion REIT because it had a 10-year lease on it for $178 a foot. That purchase price inflated to today when would have gone from 45.47 million. It was 247. 45 million 257. It would be close to 60 million today. Okay, so yes, Houston is the fourth largest port in the country, and it is a very large exporter of manufactured goods, primarily for oil and gas exploration, but for lots of other stuff too.
Just a little bit about our track record, quantity of number of buildings we've done and how we acquire so low of a basis.
Yeah, so we track about, how many buildings are you tracking right now in Houston? 110?
We started tracking about 600, now we're getting sort of whittling those down in the neighborhoods in 2017. Now we're starting to stream.
So because we knew the effect of the oil fall, we started tracking 600 buildings in 2017. We probably narrowed it down to like 150 that are in the 7 or better out of 10 neighborhoods. We call them directly every quarter. We're not waiting for brokers to bring us stuff. We do see every building that's brokered because we're the most likely to close, but we're always usually the lowest price. We are getting higher and higher quality assets because of our reputation. This is about our 80th or 90th building. We just discovered that we don't actually know how many individual buildings we bought, because sometimes we buy campuses that have 3 or 4 buildings on them to begin with. So, you know, we've been doing this for 20 some odd years, just in the office market since 1994. Okay, so almost 30 years. And we found a way to cut the cost of construction on the interiors by almost half by purchasing all the materials wholesale from the actual manufacturers. And Andy over here can speak to that.
Yeah, I'll go a little detail on that. I think a big part of our competitive advantage is building spec suites at a cost-effective rate. With us buying our rights direct and buying about a container at a time, we cut the cost from about $120 per fixture down to $50 a fixture. Our flooring, we're able to save about $3 to $4 per square foot. Our glass and our AC registers were 50% on the dollar compared to our competitors. Now, us buying those materials directly and building our suites out on a speculative basis, we create a product that's move-in ready. So tenants have a place. If they wait too long in their cycle to negotiate a lease, we become the preferred option because it's ready to go. Now, our spec suites will accommodate 85 to 90% of their need, and there'll be a little bit of modification needed. And we're able to house them, get them out of their previous space, which probably their lease has holdover, house them, and modify the space to fully suit their needs while they're already occupying the space.
We like trying to help people who are in trouble because we get to charge them a little more.
And being able to solve those problems quickly and cheaper, that's our secret sauce in a way.
And you're walking into a space that feels like you want to work there. I mean, we walk into it every day. It really is. You know, it's open, it's light, it's somewhere you want to work.
Yeah.
Hey, this is Lanisa Adams. I have a couple of questions. It's a nice presentation. Thank you for doing all the work. Question 1 is on investment, what sort of return would you expect? You know, what type of return, etc. And then the second question is, could you please speak to risks and threats a little bit, including things in the financial and economic world, you know, such as inflation or demonization of energy, etc., and how that might affect your project?
Those are good points. What was the first question?
Expected.
Oh, okay. So we underwrote this to a 20.5 unleveraged return using 3.5 out of 10 expectations. When I say 3.5 out of 10, that means I'm going to tell you I'm going to lease it for $13.50, and I'm going to actually lease it for 16 or 17. If I tell you that I'm going to sell this building in 4 years or fill it up in 4 years, I'm pretty sure I'm going to fill it up in 2.5 or 3. So we try to under promise, over deliver as much as possible through the process. A 20.5 unleveraged is probably one of the highest IRRs we bought on. We used to underwrite to a 13 and be happy with a 14 or 15. So if we put debt on 50% of this asset as we are leasing it up, it will have a 26.5% internal rate of return per annum. And if we beat our expectations, it'll go into the 30s. If we end up leasing the last space at $18, we'll definitely be in the 30s. So does that answer your yield question?
That's awesome. So I love sandbagging in numbers. So great job there. You know, and overperforming, right?
Well, you don't get 900 investors unless you're sandbagging all the time.
That's awesome. So for part A of the question, or question number one, so would that return to the look like some percentage in the bank each month, or would it look like a return once you sell a property?
It'll be a return once we sell, and it'll probably be put in 200, get 400 back.
Great. And then if you could speak to risk and threats.
Well, I don't think there's any chance that the transportation industry or the manufacturing industry or the power industry is going to let go of natural gas and oil products. I think the plastics that we all use every day is not going to change. The risk to this asset is oil that goes to $20 a barrel again. That could cause a delay in the timing. We don't think there's anything that's going to keep California from moving to Texas. As a matter of fact, we think it's going to accelerate. The accelerants are a mansion tax of 5.5% in LA, reparations being spoken of in San Francisco, the worst mayor getting replaced by an even worse mayor in Chicago, and New York is going to have to raise taxes to pay for its negative cash flow. So, you know, we're in a really, really good position in Texas. You know, I don't know of any shockers coming that could hurt the office building market in Houston. Certainly nothing is going to stop the in-migration, which will automatically fill 4 or 5 million square feet a year.
Awesome, thank you.
One additional point, you said it very eloquently. I think it was demonization of oil and gas. These are not only oil and gas companies, they are energy companies. They are also leading the way in the renewables and everything else. So yeah, there is the backup plan there. So
well, the tenant that was in all 4 of these buildings was a specialist in pipeline engineering. They got bought by a company from Aberdeen called John Wood PLC, and now John Wood PLC is being bought for $2.2 billion by Apollo, and Apollo doesn't buy anybody unless they think they're going to merge them with 2 other people and get some big government contracts. So I can tell you without any uncertainty, there's more engineering prowess in Houston than any other city, and these contracts are going to go to people that have engineers on staff. So I'm not going to be overly optimistic. I'm not going to say, hey, we're going to fill up with a 100% lease to an engineering firm in 18 months and sell this thing for 60 million. But you know, those are the outlying possibilities of what could happen here. If we get 100,000 foot tenant, and 250s, and then some 25s, I'll be damn happy as long as the rents are higher on each tenant as we sign them.
So one last question, you probably addressed this in the slide, which I didn't see, which is, what is your anticipated holding period, assuming the conservative window?
What did we put, 4.5 years? 4. Put 4?
Very conservative estimate of 4 years.
4 years, but our average partnership for the last 30 years has been 4.6 years. COVID has driven some of our 18, 19 holdings to probably end up being 5 or 6 years. But we're getting better at doing things faster and leasing things faster. So, It could be 3.5, it could be 4.5, but I think 4 is a good estimate.
Thank you very much.
Could you speak in general to the overall market trend, which is occurring on, say, leases that are expiring in the next 1 to 3 years and even beyond that, for companies that are looking to downsize the space they're presently leasing into shrinking their footprint, and or just deciding to buy out the lease and step out of the property altogether as they move their kind of office requirements to a more of a hybrid format?
Yeah, we don't see that trend continuing. We see more and more companies requiring people to be back at work for education, for emotional connection, for mentoring, and for productivity. There have been many studies about productivity showing everybody that it's not as productive. People get interrupted all the time, and they are, there's also one company who found out that one of their employees had 3 different paychecks, and they weren't from, they were from 3 different employers just because they had 3 different IP addresses. So, I mean, yes, people are downsizing, but they're asking for more space per person when they are downsizing. They used to have 5.5 per thousand. Now they have 4.5 per thousand, but they want, more square foot per person. So we don't really see, we hear those things, but we're not seeing them.
Yeah, and recognize that the market in general, the business environment in general in the state of Texas is different than the rest of the country. You've made that point. Your research supports that point, and I read about that point regularly in the Wall Street Journal. So understand all that. But I think that the migration or the evolution of the office market is still kind of unpredictable at this juncture, and that's why I asked that question. You have a lot of the people going into the office Tuesday, Wednesdays, and Thursdays. You have the new concept of hot desking that's out there, where there's shared desks and that sort of thing. And the truth is, we don't know how that's going to play out in overall office demand. But recognize in Houston, with regard to energy and engineering and metro growth and population growth and all those things, it makes Houston its own metro, kind of maybe independent from a lot of the other trends that are occurring in the country. And anyway, it just there's an element of risk there in general that is unpredictable at this juncture. And I'm just trying to get more comfortable with it.
Well, why don't you put up that macroeconomic? We're going to talk about macroeconomic movement and value. This is a really good graph for you to understand that the longer the lease length, the more stable the property type, then the lower the amplitude of the wave. So industrial, because they have 10 and 20-year leases, are more stable and have less turnover. So they get overbuilt. It takes longer for them to absorb. Multifamily has very short-term leases and can be very overbuilt very quickly. Office has it's a middle lease, but office grants an opportunity that you don't see in multifamily. I don't know of a single 16-year-old office apartment complex that's 100% vacant, unless it had a environmental problem or a plant shut down in a single employer town. Can you go to the next slide? So what we specialize is in finding the terrible operator at the worst part of the market, and then doing the value add and watching the market recover as we're filling a building up. And that's kind of what's going on here. This isn't a terrible operator, but the value is way down here because the building's empty. If that's the average occupied building, then the average empty building is way down here. So what you're going to find is our rental rate is so attractive that no matter what is going on in the overall market, we're going to be more successful than all of our neighbors, and we will be more full. Lower rates usually tend to have highest occupancy.
Do we have that chart on Green Street that shows the susceptible markets?
Hold on, what?
Yeah, and I saw that also in your research where it was showing that I think current lease markets in the metro were running about 1975 a square foot for Class A space, and for Class B space, I think it was running about 1350 a square foot. And I love your ability to come in and undercut the market, particularly on the front end as you fill the building, yet maintain, have profitability as you lease the space up. All of that makes a ton of sense. I'm just most concerned about the shifting, pivoting dynamic of the office market in general from a cultural and societal perspective. But, love all the metrics, love the metrics, all that stuff.
Yeah, I think fear always enters the market first, and stability quiets fear. So right now, if you're in LA and you've got a 5.5% mansion tax and people are throwing the keys back to the lender because people are leaving town, not coming to town. That's what's driving this news cycle. Lesser attractive older buildings in New York are going to get converted to residential because there's nobody that wants to take them. But that is not what's happening in Texas.
Yeah, understand that and get that.
So this shows markets that Green Street did a sensitivity analysis of which markets were going to be most susceptible to work from home trends. These are the least over here, and you can see Houston. Below it talks about the inputs, but a big part of that's commute time. So the no zoning in Houston really helps affordability, industry makeup. I mean, most of the firms working from home are tech.
And when we were doing our research, because of work from home and also wondering about collaboration, what we found, we talked to several engineers from Exxon and a few other people that are involved in that. And the bottom line we kept hearing is, we got to collaborate. We have to be together. We're building and designing things. We need to be together and look at things together in the same room. And that's where you're seeing that northwestern point of Houston saying, we got to get together. We have to collaborate.
Yeah.
As opposed to work from home.
Does that answer your question?
Oh yeah, definitely. Yeah, no, like I say, I read your 12-page research report. I follow the market, that Texas market regularly. And, I know you had, leading into this year, you had 73 million square foot of logistics space under development in Dallas market. You had about 30 million square foot under development in the Houston market. So smaller amounts in both San Antonio and Austin. But relative to what's going on in the country, there is, a nation leading development going on in the state of Texas, because the state of Texas never shut down during, other than 2 months during the pandemic. And it's a business friendly environment and all those sort of reasons. So that's why we've continued to invest with you. And, but I just was interested to hear your feedback on the nature of that questioning.
Yeah, if we get to sit face to face with a principal that owns a business and ask them questions about what they're thinking and how they see the future, we are hearing the business leaders saying, I want the nicest space I can afford so my people are as happy as possible. My people are the most important thing, and we want to take good care of them. And so moving from a 1984 building to a 2021 building, that's important to them. And that usually means moving a little further out and being closer to the school district that their children are going to, so they don't have to drive as far. So, we take servicing the tenant as important as we do our fiduciary duty to our investors. If we take good care of a tenant, they'll renew, they'll ask for more space, they'll open another. We have a tenant in Allen, Texas, who we did such a fantastic job on their move-in that they just came back and said, we want to rent a whole nother building from you in Richardson. And because you did everything you said you were going to do on time. So we will enjoy the same kind of referrals in Houston as time goes on. Anybody else?
Did you mention you had like 4 million square feet in Houston already?
Yes, we do.
And what is your typical, how much do you typically or your group put in equity wise, and what are you thinking about for this property?
Well, every single deal is different. I used to put 10% in every deal. In 1996, my investors got mad at me and asked me to come to lunch. And we were buying Houston buildings for $13, $14, $15 a foot from the RTC. And in June of 96, I went to lunch with my top 5 investors. I thought they were mad at me because I had done something wrong. And they said, Doug, why aren't you bringing us more buildings? And I said, because I ran out of money. And they said, don't you think you're being a little selfish? We want those buildings. We don't care if you put in any money. So from 1996 to probably 2005, I put in 1% and the investors put in 99%. So I know what you're asking is, will I walk away from a building that I'm personally liable on the first lien? No. Does it matter whether I have 20% or 1% of the building? I treat them all the same. So the answer on this one is I don't know. I may have to put in 3 million to get it closed, and then I'll sell shares after closing to where everybody's comfortable and there's enough money in the bank. There are certain deals I ended up buying 65% of 6500 West Soup South, which now has 2 floors leased to the University of Texas Health Sciences. I bought 75% of the Lone Star Community College. We're having a trophy made for that seller to replace the trophy we gave to the last seller that we said was the dumbest seller in the world. And now this seller gets that trophy, but we're going to add 1 more foot to the height of the trophy, and we're going to add neon lights to the top. Rodney, does that answer your question? Rodney?
Yes.
I guess so.
Yes.
Okay.
Thank you.
You're welcome. Anybody else? Referrals.
Investor.
Oh, so one of the things that we've done since 1991 is we've offered every single investor, individual investor, not corporations. We've offered them a first-time investor put option equal to 100,000. So if you put in 75 and you needed your 75 back, you had a 30-day put against my net worth, and I was obligated to buy you back. That was 30 years ago. And we have recently decided to raise our first-time investor put option level to 200,000 for first-time investors for the life of the partnership. The other thing is, many of you have been investing with us for 10 or 15 years, and we have built this business on referrals. So we're very proud when one of our clients thinks of a friend or a family member that might like to join. And we wanted to recommend that on this asset because the basis is incredibly low and the risk is also incredibly low. Judith Clarkson, you've been investing with me since 1992 or 3. You're on mute, Judith.
Yeah, I guess for 30 years.
30 years? Oh my God. That means Dr. DeLavo, who's been in 46 deals with us, has also been investing for 30 years. And our friend Dr. Maxwell put a large investment in our MBM number 9. And on Tuesday, he's about to receive 3 times his money, but he already got all his money and an 8% return back. So, we love it when we sell them and get to see a smile on people's face. Judith, are you in MBM number 9?
I don't think so. I actually, if you're going to get off onto other buildings, I do have a question about Richardson, which has been a big disappointment. Do you have any comments on that?
Judith Clarkson. You shoot Judith Clarkson. Yeah. We don't want to get stuck in answering questions about every building, but I'm going to call you later and tell you all the good news about that one, because there are 3 tenants. There's 2 tenants about to sign, and one of them is a previous tenant I just talked about that asked for another building.
Okay.
Okay. I think that building will be ready for sale at the end of the summer.
Hmm.
Okay. Thanks, everybody. Does anybody else have any last second questions? Okay, we're gonna discontinue, but this is good.
Doug, comment, Doug.
Yeah.
Congratulations on your quote in the Wall Street Journal related to the Exxon purchase in that property. So, you know, they're calling you and getting your comment on it. So it definitely has CCI on the map.
Well, thank you very much. It's a super exciting project, and I'll call you and tell you a couple of the things that are happening there.
Yep.
Okay. Thank you. Bye-bye.
Bye.